You spot a stock climbing steadily. The green candles look unstoppable. You click buy, and almost immediately the floor falls out. The chart shatters, taking your position with it. Here is the trap almost every new trader falls into, assuming that a rising price means a strong asset. Price only tells you where an asset is right now. It tells you absolutely nothing about how much energy is left in the tank to keep pushing it higher. To fix this, many people turn to standard indicators, like waiting for two moving averages to cross. The problem is, these are lagging signals. By the time a traditional moving average crossover confirms a trend is reversing, the price has already plummeted. Relying on these late signals forces you to buy in at terrible prices. Because you're entering after the move has already happened, you have to set incredibly wide stop losses just to survive normal market fluctuations. You take on maximum risk for minimal reward. To solve this, we need a way to measure market momentum, the underlying speed and force of the price action. This is where the MACD comes in. It stands for Moving Average Convergence Divergence, and it evaluates the strength of a trend to identify reversals before they become obvious on a standard price chart. Trading based solely on raw price is driving blind. The MACD exposes the momentum behind the move, providing a look at the underlying strength of the market's engine. To understand how it gives us this edge, we have to step away from the live market and build the indicator from scratch. This chart shows the foundation of the calculation. We start with two exponential moving averages, or EMAs, which track the average price over time. We have a fast 12-period EMA hugging the price closely, and a slower 26-period EMA trailing further behind. The MACD line is the mathematical distance between these two moving averages, plotted on a separate panel below the main chart. When the two lines above move further apart, the MACD line below goes up. When they converge, the MACD line drops. Because it measures distance, anytime the MACD line drops below its horizontal zero axis, it proves exactly when the fast 12 EMA has crossed beneath the slow 26 EMA on the main chart above. But the MACD line by itself is too erratic to trade directly. To fix this, we apply a signal line. This is a 9-period moving average of the MACD line itself, which smooths out the data and creates a stable baseline. While a standard EMA crossover only triggers after the price has already turned, the MACD measures the rate at which those averages are closing in on each other. By the time the erratic MACD line crosses its signal line, it reacts to the shift in price energy significantly faster, providing an entry much closer to the actual peak. By mathematically extracting the distance between two moving averages and smoothing that output, we've built a trigger mechanism that gives us a definitive head start. This brings us to the final component of the indicator, the histogram. These vertical bars act as a visual pulse. They measure the exact distance between the MACD line and the signal line. When the histogram bars expand and darken, it proves momentum is surging. The gap between the lines is growing, indicating the current trend has strong backing and you can confidently ride the move. As soon as those bars peak and begin to shrink and lighten in color, the momentum is fading. This is your early warning system. The trend is losing steam, and it is likely time to exit your position. This visual pulse sets up the MACD's most effective application, divergence. This is how the MACD identifies trend changes before the price itself turns. Here is how it works on a chart. A bearish divergence occurs when the raw price makes a higher high, meaning the asset is technically still climbing, but the MACD indicator contradicts it by making a lower high on its histogram. Think about the psychology here. The price is going up, but the mathematical force pushing it is decreasing. The buyers are completely exhausted. The upward movement is running on fumes and about to snap. The MACD tracks the invisible tension of a dying trend, capturing the exact moment before the rubber band breaks. The MACD has limits. Relying solely on its line crossovers during a choppy sideways market will trap traders in a nightmare of false signals. Professional traders never use the MACD in isolation. Instead, professional traders use it strictly as a confirmation tool, layering its momentum readings over strong structural market boundaries. Let's look at this chart to see our first advanced strategy. We require a MACD divergence to trigger only when the price has hit a known ceiling, like a horizontal resistance level or the outer edge of a Bollinger Band. When price hits a wall exactly as momentum dies, you have a high probability reversal. For our second strategy, we look for zero-line pullbacks. In an established uptrend, we wait for the price to dip down to an underlying moving average band. Exactly as it touches that structural support, we look for the MACD line to dip and touch the zero line before bouncing. This confirms the pullback is over and the trend is resuming. By layering these distinct concepts, you create a filter. You stop trading every random blip of the indicator, and instead use structural boundaries to mathematically validate the MACD's momentum readings. Once you understand this combination, you are no longer looking at charts as simple flat lines bouncing randomly up and down. By mastering the convergence and divergence of momentum, you stop reacting to the market's shadow and start anticipating its next move with precision.